Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500, and most importantly, we're going to be talking about this ratio here. A lot of people have been asking me about this, the J&K to TLT ratio. This is the ratio between junk bonds, so low quality, high probability of default bonds, and treasury bonds. So in other words, what investors consider to be a safe haven. And you can see this ratio is coming into a level of resistance that is going to change absolutely everything about the market environment that we've had throughout the past couple of years. We've been in a risk-on environment where J&K has been outperforming TLT. Now we're getting right into that reversal point. We're going to be talking about this in the video. But of course, most importantly, what that means for the stock market, what that means for the SP 500, and what kind of opportunities we can find in this new environment that we're entering. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoyed this episode, smash that like button. And now, without further ado, let's get right into it. Now, I want to begin by quickly taking a look at this chart of the yield curve. I talk about this in most of my episodes because it is such an important concept to understand. This is the 10-year minus the 2-year. This represents the business cycle. It is the best predictor of recessions. You can see we saw an inverted yield curve throughout the month of April. We've shot back up a little bit, but in general, we're in that recessionary zone between 0.2% and below 0%. That's when you can say, looking forward, looking 1 to 2 years out, you're going to have a very significant slowdown in the economy. And the reason for that is because banks, commercial banks, borrow money on the short-term yield and they lend money on the longer-term yields. So if you've got an inverted yield curve, they are basically losing money when they're lending to other people. And we know our entire system is based on credit cycles, booms and busts. And so when it's not profitable for banks to be lending to people, that's when you start to get closer and closer to a bust. And we know how leveraged our economy is. I don't think it's going to take very much of an inverted yield curve to create that type of environment. If you want further proof on that, I can show you this chart from one of our recent articles on gameoftrades.net, and that's the unemployment rate versus the yield curve inversion. And you can see the 10-year minus the 2-year, so that same chart in blue that we just took a look at, against the unemployment rate. You can see systematically when you have that inverted yield curve, it's followed by a bottom in unemployment, meaning unemployment begins to rise following that bottom, because you go from a credit expansion cycle where banks are lending a lot of money to a credit contraction environment that creates a slowdown in the economy. Now, this may sound all very doom and gloom and very bearish, and you would be absolutely right. It's not good news. It's not good news for long-term investors. And I know a lot of people out there hate to hear this because it's true. We've been in a bull run for the past 13 years, but that's not always the case. You can have market environments where the market goes down for a decade nonstop, like between 2000 and 2009. It always makes me smile when I hear everyone refer to Warren Buffett here as the market is nearing the end of its 12-year bull run. Warren Buffett is the reference, but you also have to keep in mind that Warren Buffett averaged a negative 40% return between 1999 and 2009. That's 10 years where he lost 40% of his portfolio, right? So ask yourself, are you willing to endure that type of volatility? Because that is just the harsh reality of the stock market, right? It doesn't always go up. What I also wanted to mention is that yield curve inversion, so the end of the economic cycle, doesn't necessarily predict a bear market straight away. In fact, returns are actually pretty good once you have a yield curve inversion, right? Yield curve inversion in 2006, massive return throughout 2007. Here, November 2018, yield curve inversion, massive returns throughout 2019. Yield curve inversion in 1998, massive returns. So yes, it signals a coming economic downturn, but you can still have a very strong equity performance. In fact, these were some of the strongest stock market years in stock market history. So I think that's important to keep in mind. Now let's quickly take a look at the technicals here as I'm on this weekly chart of the SP 500. We have not changed this price channel for months, if not years. And this has just been a beautiful technical level to watch because of how well it has been respected, right? In March, April 2021, we broke out, retested, and resumed the bull run. Here, we had yet another retest. All right, so, we're looking at that very carefully. This is not the only thing we're taking into account, but ideally, from a technical standpoint, you want to see the stock market hold above this level. Now, could we have an intra-week move down? Absolutely. We had a couple of closes below this, right? And we saw the market snap back up above. That's bullish. That makes this a false breakdown. But now we want to see this move up hold, right? So we can't see much more downside here without having a significant invalidation signal of this price channel that could potentially take us down into this range here and potentially even into the bottom of the price channel, right? I don't think that's going to happen for many, many reasons. But if you're looking at TA very, very objectively, then that's what you would expect. Now, on the flip side of that argument, if we hold that level, which I do expect we will, I think the low is in here. I think this false breakdown is going to play out in a big way. Then you're looking at a very beautiful setup for higher highs with a nice head and shoulder pattern that you can make out very, very clearly here. A breakout above this line of resistance would be massive. It would be so bullish for the stock market. It would bring so much momentum, so much FOMO back into the market. The measured target on that would be around 5,270 points, which I don't think anyone is expecting right now. Because from current levels, that's a 18% move higher. And from the bottom here back in February, which if you remember, if you were following us throughout this period, we were very, very bullish on the stock market. That's a 26% run. The type of return that would take around, 4 or 5 years to achieve in the stock market. So you can understand why after such an extended period of outperformance in the market, like we've had throughout 2020, 2021, and potentially what I expect will be a good first half of 2022, you can understand why that can lead to severe periods of underperformance. All right, let's take a look at that ratio that we talked about, the J and K divided by TLT. Unfortunately, we don't have data going back further than in 2007, which is very unfortunate because we can't draw many conclusions about the economic cycle, but we can draw other conclusions. I'm going to talk about that in just a second. So J and K divided by TLT, you can also name that risk on, which is J and K, because investors are invested in high yield bonds when they're confident about having a lot of risk exposure, and divided by risk off. So when you see this ratio rise as it has throughout 2020 and 2021, you're generally in a risk-on environment, a risk-on bond market environment. When it's falling, you're in a risk-off environment, like we were back in 2008, obviously in 2011 during the European banking crisis, in 2014 during the negative GDP growth of 2015 and 2016, and of course the risk-off environment from 2018 to 2020, where we had a massive COVID plunge in 2020. So if we have a rejection here of this price channel resistance, which has clearly acted and clearly proved itself as a very, very important line of resistance, well, if that happens again, we can expect the bond market to enter a risk-off environment where J&K would be outperforming TLT. Now, I don't like to rely just on technical analysis, right? And we don't. But when this type of setup aligns with, for example, a yield curve inversion, which is pretty much the ultimate risk-off signal, then that gives me a pretty high degree of confidence that there's going to be some buying pressure here for TLT, and there's going to be selling pressure for J&K. People are going to de-risk by selling junk bonds and buying treasury bonds. Now again, this might sound very, very bearish, but the fact of the matter is that if we do have a rejection, that doesn't necessarily mean that the stock market is heading straight for a bear market. And the perfect example is here, right? We had a massive, massive move down on the J&K divided by TLT ratio. Let's take a look at what the SP 500 did throughout this period. It rallied massively, right? Now, we've already talked about how similar the correction from 2018 is to the correction that we've seen now, right? We had the Federal Reserve tightening throughout this period very, very aggressively, and yet we had a yield curve inversion, and yet we had the yield curve invert throughout this period. And so once you had that yield curve inversion, you had the market start to anticipate easier monetary policy. That's exactly what happened throughout this period. That is why the stock market went from 2,400 points to 3,400 points within the matter of a year. Now, throughout this entire period here, investors were very concerned about rising yields. Let me put up the 10-year yield on this chart so that I can show you. Right, when you have rising yields very, very aggressively, investors start to get concerned about market valuations. You don't want to see the 10-year yield too high if you own expensive stocks, right? Stocks were expensive here, stocks are expensive here. So when you have very rapidly rising yields like we have now, well, that creates a sell-off and volatility on the SP 500. So it's only when yields begin to cool down that you start to have a rally in the stock market. So I know I'm going to get a lot of criticism for saying this, but seeing a rejection off this trendline resistance, it's actually going to be bullish for the stock market. Why is that? That means investors are getting back into TLT, right? They're getting back into treasury bonds. If treasury bonds rise, what happens to yields? Yields go down. In fact, I'm going to show you that by putting the yields back on this chart. And you can see every time that you get this, every time that J&K divided by TLT hits that line of resistance, well, you get yields that top and reverse. It hits the line of resistance, yields top and reverse. Hits the line of resistance, yields top and reverse. Hits the top of the resistance, yields will top and they'll reverse, at least that's our opinion. And so in this particular case, because investors have been so worried about rising yields and the tightening of monetary policy that's coming with it, it makes the correction that we're seeing very, very similar to the correction that we had throughout 2018. And so if we reverse off this trend line here, that's going to set off the next move of the bull market. As all the investors that were concerned about rising yields throughout this period are going to jump back into the market. In fact, I made an article last week highlighting why bonds are at a historically oversold signal and very close to a major bottom. I went through just everything that we look at, the technical picture, right? They're at support. They're overextended relative to their big moving averages. The intermarket analysis that we follow is not confirming the move up that we're seeing in yields. But most importantly, and I want to show you this chart, the sentiment is showing us that investor sentiment is so bearish on treasury bonds. This is a measure of the investor sentiment on treasury bonds, and you can see Of course, they've been moving down very aggressively, and it's triggering a signal that we've only had a handful of times throughout the past 15 years of just extreme pessimism on the bond market. So, that tells me when I look at this chart that we're very close to a very big bottom on TLT. When we see everyone move in the same direction, that's usually when we're looking for opportunities looking the other way. Now, obviously, we're bullish on equities. We think they're moving higher, but that doesn't mean we're not aware of the massive risks that come along with it, which is exactly why we're adding treasury bonds to our trading watch list. We are actively looking at gold that we think is going to be a massive outperformer over the next few years. And we're going to be looking to make regular updates on these trades as we see opportunities, as we see key developments and key levels. It's been absolutely great getting your feedback on these articles and seeing that it's helping people navigate through the market in a more successful way. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button. And now, in the meantime, I wish you good luck on your trading and see you next time.